Welcome to Market at Close. I'm your host, John Rowland, bar chart senior market strategist. This week felt like Lucy pulling the football away from Charlie Brown as Nvidia's earnings popped the market only to create one of the largest intraday reversals I've seen in years. Now, I want to show you a lot of charts today, hopefully to give us some direction to this volatility, plus two of my new picks and a special announcement. So, as usual, let's get right to it. And to help me along with today's session is Bar Chart's Twitter Tom and our Mr. X. Hello, Thomas.
Hello, John. How are you?
Woo! Volatility is the word for the week, huh?
Yeah. I mean, it's. I've been asking for it for weeks, right? I mean, we've talked about it. I've been begging for volatility. Finally, we got it. It's great because that means we have a lot to talk about today in the show, John. And we do want to get to that. I just want to give everybody a quick reminder: if you're watching on our website and you want to ask us a question, click "Ask a Question" at the top right. You'll see it in the orange color. And if you're watching on our social channels, go ahead and leave those questions in the comments or the chat. And as usual, John and I will get to as many as possible. All right, John. So let's kick it off with the star of this week's action, the S&P 500. We've talked about cracks potentially forming underneath the surface, right? That was the theme of last week's show, and those cracks appeared to widen out a bit this week, John. In our preparation, I think this has been going on for months, right, John? Every time we talk about bearish material, I say, hey, you know what, John? I want to see 3 red days in a row before I even get remotely bearish. And guess what? We got 4 red days in a row this time. We had the close below the 50-day moving average, which is something we've talked about a lot before. We also had a crossover, John. We had the 8-day EMA crossing below the 21-day EMA, which was a sign of potentially some short-term weakness. The last time that happened, John, was much earlier this year, which did mark, in fact, the next big market correction. So, John, lay this out for us. Are you feeling bearish? Are you feeling bullish, or somewhere in the middle?
Well, let's start off by saying that the sky isn't falling and corrections are good. This just allows us to buy assets cheaper. And this market volatility, I think, is more of a reflection of the high concentration of these, the weighting of a few stocks inside of our indexes. And although we're going to see a lot of evidence that short-term trends and momentums have been broken or have flipped, the higher time frame weeklies are still intact. So here's your first chart, right? So the 821 and 34 EMA, and what do we see? Well, we see multiple crossovers and down sloping. This is bearish. There's no doubt about that. If we go to our MACDs and our RSIs, which you know that I love to look at. So let's talk about the RSI. So normally in bull markets, we get this kind of shift in the RSI. And what happens is the RSI usually tends to stay above 50, and rarely in bull markets does it fall below 40. So what we can see here is that our RSI fell below 50, and we also broke below 40. So this is now telling us that whatever bull market or bull trend or uptrend that we have been a part of, that is now ended. Now, what this could signal to us is the beginning of a new downtrend. Now, we don't know that as of yet, but the RSI is telling us that there is still more room to the downside. It's not oversold. Now, if we think that we're going to be in a neutral market, well, then what we would like to see is that our RSI get back above 50. But in bear markets, the RSI shifts down. And so then the upper end of the range, 60, becomes resistance. And so that would be something we should look for if we do get some kind of a dead cat bounce here. Can the RSI get above 60? If we talk about our MACDs, right? Now, the MACD is a momentum indicator. But when the MACD falls from above the zero line, this down here, that is just a correction in the market. And that's what we kind of saw here. But when the MACD crosses over the zero, that is a confirmation or a signal of a downtrend. So bearish in that sense as well. So let's go to just a regular chart here, and I want to kind of show you something here. So first of all, this big red candle is called a Mariposa, and we've talked about these before in other sessions. So this number over here, 38.2 and 50, which is this line right here. What this represents is a Fibonacci retracement from our all-time high to yesterday's low, that 38.2, and 50 being 50% of the Mariposa. And so both of these now represent a layer of resistance. Now, I drew these lines out this morning, and I found it very, very fascinating today that on our recovery, our little bounce that we got today, that we literally stopped just below them. Okay, the 661.21 level is our previous 4-week low. And now this is going to become a battleground for our bulls and bears. Old school technical analysis tells us that when you make a new 4-week high or a new 4-week low, that has a tendency to confirm a trend. So right now we're right there, right? We don't have a decision, but if we settle below that, that would be a confirmation that we're probably in a new downtrend. Now the 652.84 level is the low of the last Mariposa, which is over here. And that as well is where we talked about our recent buy the dip accumulation of all this new length that came into the market back in October, which is represented by our pink box. Now, if we change our template here and we go to, let's say, a Bollinger Band, you know how I love Bollinger Bands, Thomas. I'm going to go from daily to weekly. That again, that number, that 652.84, lines up with our mean at the weekly level. And if I change my template one more time to one of the ones that we like to look at, which is our 20, 50, 100, and 200-day moving average, you can see that that also lines up with the 100-day moving average. So all of these are supportive to a much higher time frame analysis. So, but we're still below that critical 50-day moving average, which is around 669, which is our blue line. And what looks like what happened today, Thomas, was that the pump police, in other words, our market makers, were trying their best to push the market into what we call a neutral gambling exposure or our max pain. So I just want to make sure I have the right, yep, I do have the right expression. So you can kind of see, right, they want to kind of pin the market down somewhere between where they have a downside risk, where you can see a large amount of downside risk here, and upside risk. And that would be this goalpost that we kind of look for on the max pain. And that looks like we're right at that value, right? That value around 661, which also, remember, was near that new 4-week low. So we're kind of pinning the market right down into a level of decisiveness. All right, so I want to look at the market from a little bit of a different perspective, and that would be from an idea of, let's look at this market on the equal weight. In other words, we're not going to look at the indexes that are top heavy with the market cap weighting of our Mag 7. So let's look at the S&P here first, which is on the left. And it does look to me like this is a distribution top, but let's look at, excuse me, I got it off here. There we go. Does look like a distribution top, and what looks like to be our line of risk is around 185. Our 50-day is above us at 188, and our 200 is below us at 180.77. So we're kind of stuck in this middle, right? This indecision. But you can see that right now we are above that line of risk. Now, if we look at the equal weight of the NASDAQ, what we, again, remember the NASDAQ is tech heavy, a lot of our AI stocks, a lot of stocks that we talked about that might be showing some of the crack. To me, this looks very head and shoulderish. And we are, which is a little bit different from our equal weight from the S&P, is that we are below the neckline. We are below that line of risk. And again, I think this is what, this is kind of just reinforcing what the ideal is, that maybe the market is just taking a breather from some of these stocks that have really jumped really high over this year that were based on an AI play. Now, if we do a projection based on the head to the neckline, which is just standard head and shoulders type projections, we can see that projects down to a range between our 200-day moving average here in black and our June lows. Okay. Neutral market with a higher time frame analysis, downtrend developing in a lower time frame, looking like the market is projecting to a lower value. So let's move that to our our NASDAQ and see if we can overlay that analysis to project a lower level. And you can see here that does set up for a much relatively lower level. So what's the takeaway here? Well, there's going to be many buying opportunities between now and the end of the year. And I think you should start finding a list of stocks that you want to own. So what I want you to do is I want you to look at those that have already fallen and that have found support at their 200-day moving average or that June low. Now, notice the June low does have a gap, and you know how we love our gaps. So if the stock is below its 200-day moving average, wait for it to recapture. And onto the upside, well, we still all about our 50-day moving average, Thomas.
Very good. A lot of great information there, John. A lot of stuff for us to watch over the coming weeks. But John, there's going to be a big thing, and I'm going to mention it in a second. But I first want to say, a lot of you have probably heard that we have partnered with Kalshi to be our exclusive prediction markets partner. John, I'm very excited about this because I've been looking at Kalshi for a long time. Our viewers know I've mentioned Kalshi before. I tweet about Kalshi all the time. So this really fits with a lot of the things that we do. And over the coming months, you can expect to see Kalshi's markets data content integrated on Barchart's website. So expect to see updates about that potentially as early as next month. Now, we're going to try and incorporate more of these prediction market odds into our shows, John. And we're going to start today. And we're going to kick this off by looking at a big event that's going to happen next month. And that, of course, is whether the Fed is going to cut rates. Now, back in late October, John, as you can see on this visual from Kalshi, the market had a rate cut pegged at about a 90% plus probability. I mean, it was basically a shoo-in, John. Everybody was counting on this happening, but the odds of that happening have cratered. Now, I think this is mainly due to the fact that the Fed keeps saying that they're evidence-based. Unfortunately, due to the government shutdown, no evidence was given to them. So they might be getting some cold feet on whether they should cut. But I've often said, John, I like to be a contrarian at times. I've always felt the Fed was going to cut in December, regardless of what the odds are telling me right now. The Fed doesn't want to be the Grinch who stole Christmas. So if you made me pick, I'm going to take the rate cut odds of happening here, pegged at about a 33% chance. I really like those odds. But John, you're more of a gambler than I am. So where do you stand on this rate cut decision? And how would you incorporate this into your own trading?
Yeah, so I think, you got to look what the Fed's doing. They're already putting liquidity in the market. They've been active in the repo market, which is kind of an idea that maybe there's some stress in the banking market. They talked about, this fog of data or lack of government data, but, I don't think you need to be a lighthouse keeper to see through the fog. Verizon announced 13,000 jobs cuts. Amazon announced 14,000 job cuts. So I don't know, a 1% percentage cut in the Fed funds, is that going to bring back some of the government jobs that were lost, or is it going to bring back the jobs that were displaced by, AI productivity. I don't know. But again, what I'm excited about with Kalshi is that I'm going to try to understand the mechanics of these predictive markets. And I think this is just another tool for us for event risk management. And so, I might be wrong on this one, Thomas, that I think that the no rate cut is baked into the market. And so a cut might actually be a negative event. And so a weaker economy or banking stress. And so I would venture that a cut probability as an offset to, especially if the odds are against, which it does look like right now, as an opportunity to hedge downside risk. So this is the way I'm going to look at our opportunity with our new partnership is I'm going to look at these events as risk management and not as more about speculation.
Yeah, I really like that, John. I like that approach. And I just want to point out right before we went on the show, John, it looks like the odds actually swung huge back towards the favor of a cut, 25 bips cut. John, literally yesterday, it was the exact opposite. It was 66% for maintaining, 33% for cutting. That flip, somebody must have come in here and made a big wager on that. So incredible.
All right. Well, I'm excited, Thomas. We're going to definitely dig into this deeper as we go later on in the next few weeks or so.
I'm excited to do that. There's a ton of awesome markets on Kalshi, so there's a lot for us to dive into there. So I'm looking forward to see how that evolves over time. All right. So, John, we said the big star of the week was the S&P 500, but there's another candidate for big star of the week. That was potentially the most important earnings announcement of our lifetime. And that, of course, was Nvidia. Now, I feel like I jumped the gun here a little bit, John, because after Nvidia's earnings, I made this post on X.
I loved it.
That they saved humanity once again. You can see that huge green candle, John.
Yeah.
They beat, they guided, the market loved it, but then the market didn't because the stock fell off big on Thursday. I think it's only up a little bit today. John, what went wrong for Nvidia here?
Yeah, you never know with earnings, right? But this was a huge rug pull. And you think about in terms of market swing, I think this was a 5% swing, right? Or no, excuse me, an 8% swing. It was up 5% and then down 3%. So that's a huge movement in any market, right? Let alone the most largest company in the world. So let me put up my chart here, and this is the Nvidia stock. And first of all, I just want to show you that, one of the templates that we use, our 20, 50, 100-day template, does give you a comparison to the S&P, and we know that Nvidia is about 8% of the S&P right now. But you can see that this has started, the Nvidia is underperforming the index itself, which is really kind of interesting. Let's go on a little bit of a smaller picture here. And I'm going to get rid of that comparison. So there's our Mariposa, right? And again, Mariposas are decisive controlling candles that represent breakouts, climactic moves, continuations of strong trends. But in this case, I think this is an exhaustion when it appears after a long run. And I think that's exactly what we're seeing here. So you can see that we're kind of between right now, currently, or between the 20-day moving average and our 100-day moving average. Now, we are still below our 50-day moving average, and you can see, and then this is what I think is going to be what I was kind of like the point I was making in the last swing, is that how much farther we are away from our 200-day moving average for this particular stock. Now, if we go to our Bollinger Bands, and you can see that our Bollinger Bands are a little bit wide, right? And that's telling us a lot of volatility, obviously. But notice that, the lower end of the Bollinger Bands does sometimes act as a level of support. And that comes in around this 175, 176 area, which does line up with previous lows. But our Bollinger Bands are just turning out just a little bit here which could be a sign of increased volatility and increased volatility, what looks like to the downside. Now, if we take that analysis we did with the S&P and the NASDAQ, well, then we can think about our 200-day moving average, which comes in at around 152.73, and that range near those June lows around 157.23, 154, which is represented over here. So yeah, I think that this one we have to really watch, and I really think that the key number for us is this low here, and that is around that 176.63 level. If we get below there on a weekly basis, weekly close, then I think the market is going to set up to test that 200-day moving average and our June low. Okay.
All right. Fantastic. Yeah. I mean, Nvidia, John, the thing about Nvidia, people sometimes forget, I mean, it really controls the market at this point. I mean, it used to be Apple, right? Everybody said it, as Apple goes, so goes the market. Now it's flipped, right? Now it's as Nvidia goes, so goes the market.
So again, the point being is if we think the index is going to fall to its 200-day moving average, well, it's because this one goes to its 200-day moving average, right? Or to the June lows.
Exactly.
Okay.
All right, John. So let's move on to a space that we don't talk about a ton, and that is, of course, healthcare. Now, I just put this together, John, because healthcare has been going really through it. Been getting absolutely killed. This is an expression. You can create this by clicking the FX at the top of any bar chart, interactive chart. This is healthcare's performance relative to the rest of the S&P 500 over the last 3 years, John. It's been getting absolutely killed, but there appears to be a little bit of momentum. You got some huge candles there at the end. I've also seen stats, John, about hedge funds reportedly massively increasing the healthcare exposure over the past couple of months. So, John, the question for you is, would you be a buyer of something like a healthcare ETF, or do you think there's a better way to play this momentum?
Yeah, so that's a great question. I don't want to own the XLV because I don't want that exposure to the managed healthcare risk, right? The insurance companies. But I do like big pharma. I do like the medical device space. And that goes one of our previous discussions or narratives about our aging population. So here I'm pulled up on my space, my chart. Can you help me out here, Thomas? Yeah. There we go. So we're looking at the market. This is kind of what you're pointing out. Here's some stock market and sector performance. And what I'm looking at is since about September, and what we can see is the outperforming, right? Most of the sectors are down. The outperforming sector here, almost up 13%, is the healthcare space. So what we can do now is we know that money has to flow out of the AI, and that some of these money managers will have to be 100% committed or 100% allocated. Where are they going to put their money? And obviously, we see money is flowing into the space. Now, previously, a couple of weeks ago, we talked about at market tops, we looked at a couple of energy trades. I know that the Valero trade, some of you jumped the gun on it, but it didn't really pan out. But if we go from peak to trough, again, I don't know if we're in a bear market. I'm just talking about, market momentum up or down. You can see that healthcare is one of the sectors that money will flow into. So I'm going to go to the healthcare space, and I'm going to click on that. And then what I'm going to do is I'm going to come down here and look at the constituents, and I'm going to go by performance, and I'm going to go look at 3 months performance. Now, there is a performance theory that says stocks that outperform for 3 months will outperform for 6 months. Those that outperform for 6 months usually outperform for a year. So I want to look at these ones that are outperforming for 3 months. Now, I think Eli Lilly is a crowded trade. I'm not going to get into that one. Cardinal, that was one of Barry's longs. This is in that medical device, one-time use, pharmacies. But the one that really stood out to me was Regeneron. And the reason why is you can see the momentum in this stock has become in the last month or the last 3 months. And based on a 52-week performance or a year-to-date performance, it's very low, which tells me that this stock is bottoming and is now gaining momentum. So let's go to the chart. And there you can see it right here is our comparison to the S&P. Look how strong it is compared to the S&P. But if we look at the price action, maybe what we could say is that price has gotten a little bit too far, too fast. That's what the Bollinger Bands are kind of telling us. But very strong upward trending mean, and a lot of times the market will carry along the outer band in strong markets. Now it does look like we're up against a little bit of resistance here at 750, but it does feel like if we could break out above 750, then I think the target for this one is around $875 to $900 in 2021. Now I wanted to kind of do a piece here, but we are kind of running short on time. To buy 100 shares of Regeneron would cost around $77,000, and that might be a very expensive proposition for some folks. So I think what we could do, and this is kind of the poor man's way to get into some of these stocks, is look at leaps. And I'm going to go to a December 26, and what I want to do is I want to find an in-the-money leap, right? This is December 20. Yeah, the weekly. I want the monthly. There it is. I'm going to look at a leap that's in the money, and then, how much is that going to cost me? Now, the pricing is not right in here. I just want to make sure. Yeah, I'm not in the right monthly. There we go. So I'm going to look for one that's in the money, somewhere between 650 and 700. Now, notice that it's hard to see here the total value, but you can see it's going to cost you somewhere between 16,000 or 650 is going to be 19,000. But remember, that's $16,000 to control $70,000 worth of stock. Now, what we will do here is we could look at our expected move. And you notice that our expected move for this one is really much higher, right? Around $950. So there is a lot of room for this. And what I'm going to do is I'm going to buy the leap. And then what I can show you maybe after we get into this trade is on a monthly basis, I'm going to start selling out of the money covered calls and try to recoup some of that cost between now and a year from now. And I did look at it, and you could sell like $810 calls, which would be below the expected move for the next 30 days. And you could get about $9, which if you think about it, if I could get $9 every 30 days on this, 9 times 12, well, you do the math for me, Thomas. So that's over $100 or $10,000 that I could recoup based on this long call. And if I get that appreciation, then that's just gravy. So we'll look at this trade one more time in the near future, but I think this is going to be an interesting trade for us to look forward to.
John, lately we've had a lot of questions on nat gas, which I know makes you happy because that is your bread and butter in the financial markets. John, you've discovered something which potentially could send nat gas to the moon. What have you got for us?
Okay, so this came out, a couple weeks ago. I told you there was a weather anomaly that was happening in the upper atmosphere, and that was an idea that was going to allow cold air to flow into North America. And what that does, that weather anomaly is going to weaken the polar vortex. Now, what the polar vortex is this kind of bottles up the cold air up in the Arctic. But if we weaken the polar vortex, then what happens is you can see that it allows cold air to rush down, and the forecast is we're going to get a polar vortex somewhere between the last couple of days in November into the first week of December. And we said that we wanted to look for some weather catalysts to help us with buying a natural gas. Now, the other one, this one's a little bit, you got to use your trader's thought here, is the LNG market for Europe. And again, I told you, you got to watch this market too. This will help us give us some kind of a direction. But we have been in kind of a narrow range, and it has been a little bit down sloping. Now, this is because inventories are relatively high in Europe. And this line here represents open interest, contracts that are open. So falling markets, rising open interest is a strengthening trend. That is a speculator's market. That's telling me that speculators are adding shorts. And this is one of the highest open interests we've seen in this contract in years. And so that tells me that the speculators are short and they're prone to some type of short covering rally in event of a supply surprises or an extended cold snap. So if we look at natural gas, last week, remember, this is where we were last week. I said I thought the market had gotten a little bit ahead of itself, and I wanted to see a little bit of a dip. We got a great dip, held the mean, and now looks like we're moving higher. I want to see the market break above 489. And I think our target here will be around $5.25. Now, I'm looking at the January contract. Why am I looking at the January contract? Because the January contract represents the month of December on the calendar, which is going to be affected by this weather, right? So, again, I will look for this trade. I like this trade. I want to see this on momentum. But behind this trade, I have a friend that's in the market, in the natural gas market, and he told me that a large trader bought $7, $10 call spreads in the March contract. Now, that trader is anticipating a big move in natural gas between now and February. And if you look at the March contract, it's about $380. So this trader is thinking that natural gas prices are going to double between now and February.
John, I don't trade futures contracts, and I know a lot of people don't. Maybe the margin's just too much for them. But if you're looking to stick in the equity side, and you thought, and you take what you're saying to be true, and you want to trade this momentum, would you look to maybe get into a leverage ETF like Boyle right now?
Yes, I think this is a great instrument for that. Just remember, this is a 2-time leverage, and that the way this is designed, that it has a lot of derivative decay. So I'm a big fan of this market when the market has momentum, right? I will hold them for short periods of times, a week, 2 weeks at the most. But I don't think this is an instrument that you want to own for a long period of time, because that derivative decay could take a lot of potential profit away before you get that momentum. So yes, I like this. I like this idea. I like this trade. And you can kind of see that in terms of what we see here in our chart. You can't really rely on the values because they always change. But again, you can see that there's a relative to, let's say, if we get above $37, where's that gap that we saw, relative to the January contract. So, $37 could relate to $48.
All right. I think that wraps up our main show, John. Great job as usual. Guys, if you guys are watching on our social channels, X, YouTube, Instagram, Facebook, we'd really appreciate if you shared it, if you liked it, to let us know. Leave a comment. Let us know what you're watching in the markets. I always look at those, and we take that feedback, and we definitely incorporate it into our future show. So John and I are very appreciative of all that. John, are you ready for some Q&A?
Yes, I am.
All right, so we got a question, John, about Meta and whether we would look to buy Meta because it's just gotten absolutely crushed. Now, I looked into this, John, because I was curious about this, because we've talked about this idea of capital rotation in the past, right? We talked about it with Google. We talked about it with Amazon. Both of those worked out extremely well. Now, interesting thing about Meta, John, is the RSI, and it fell to 23, which is extremely oversold. And as you can tell, John, the last time that happened was around November of 2022. And that's when the stock bottomed out at $100, John. That turned out to be a generational buying opportunity. And I hate that term, by the way, but you have to call that a generational buying opportunity. What do you think about now, John? How does it look to you right now?
Yeah, so here, here's my chart. I got it up, and I think your point is very valid, right? I mean, we are in, RSI is super low, and again, this is a great learning opportunity. A lot of folks think just because you get oversold that's going to be a reversal, but a lot of times the market could get pinned down in oversold or overbought conditions for long periods of times, and you can see that here. But I do agree with you that maybe that this could be a potential buying opportunity based on this analysis, that when we go back to what you were talking about, is notice that we did get this sell-off here where we got an oversold, and then we got that confirmational bottom sell-off down here, which if we look at current price action, right, here's that sell-off and that RSI, and then we're now here, and which is, if you think about this, right, we're making a more extreme lower RSI, but we're not making a new lower low, and that's a negative divergence. This is one of the things that RSI can help us with. But again, if the indexes themselves, Thomas, are under pressure, and Meta is one of the larger ones that are in the index spaces, here is that example that I was talking to you about. Is not only do we have a downsloping 50-day moving average, but we are well below the 200-day moving average. So yes, I think there could be a generational buying opportunity, as you hate to say, but there are a couple gaps here. I would be more patient and wait for at least some kind of stability in this one. And I know it's hard to say this, but I might not even want to buy this one until we get back above the 200-day, because what my old adage is: what happens below the 200-day?
Nothing good.
Nothing good, exactly. And it is a little bit different from, I think, the previous time, but
yeah,
it's definitely a negative divergence makes for an interesting case for that.
Yeah, definitely.
Okay.
John, 52-week percentage change and weighted alpha, are those the same things, and how do you use them?
I have to think about this for a second.
So I can help you out here, John.
Yeah, weighted alpha is offered based on 52 weeks, right?
So weighted alpha is going to be over the last 250 days. So it's very similar to 52-week percentage, but weighted alpha is placing a higher importance on the most recent trading activity. Yes. So you ask yourself, okay, well, what's the point of that? Well, the point of that is you can easily spot momentum shifts, right? In maybe sectors, particular stocks. It just gives you a really quick look at what's happening relative to a 52-week percentage change.
Right. So a great example, Eli Lilly, which has been up, up 41% over the last 52 weeks, right? Its weighted alpha is much higher. Where Regeneron, it's over its 52 weeks, it's not up, but its alpha is rising because it is growing in the short term, right?
Exactly.
Right, because we're only up 2% on the 52 week, but the alpha here is 19%.
Our good old friend, the Hindenburg Omen, John, question: it was triggered on October 17th and October 30th, representing a mini cluster. Do you see an association between these triggers and this week's market tremors?
Well, yeah, we talked about it was a week ago or 2 weeks ago. We went over this one. And not only did it trigger, but I think it actually is triggered 5 times in the last 30 days. So
yes.
So yeah, I think this was one of the ones. And then really what this is it's just internal market momentum, right? Are we making new highs or new lows? Again, something we talk about all the time. And it's a very easy way to look at it. The other one is, one of the other components is, let me go back to my watch list here, is the McClellan indicator, which I think we need us to go standalone here. Let me just put that up there. And then that one, again, was very, very ugly looking. Yeah, I mean, that is a lot of negative momentum. Okay.
We got a question about GLD, John. I think it's
Ooh.
just the question is, what about GLD? So are you bullish or bearish on GLD?
Well, last week I told you that I thought that this was a very defined risk trade in terms of we know where our risk. And to be honest with you, straightforward, disclosure, I did buy GLD. Um, Somewhere I think around the 174.75 region. We got down, we got this gap fill, and then we got back down here again. So I thought this was a good opportunity to get into this space. And I'm into this for the long run. So I'm going to risk, I'm in around 374, 375, and I'm going to risk 360. If I'm wrong, then we could see a very big flush down. Again, this could happen to be, related to a risk off event. I told you that I had a resting order here. That resting order is now gone, and that resting order is down here. So I'm going to, if a new buying opportunity, but I would like to see the market hold here and then take out this high. So I am in this one.
We got a quick question about whether you can watch this later. Yeah, this is recorded. You can find it on our website. You can also find it on our YouTube channel. So please watch at your earliest convenience. John, are there any leading indicators that you can find on barchart.com?
You mean like economic indicators?
Yeah, I think just like any sort of leading trading indicators that, you hear this term about lagging indicators, right? People say that the golden cross and the death cross are lagging indicators. Are there any
most technical analysis is based on past performance, and so they're all basically lagging indicators. Well, but we do have one interesting piece tool, which is if you go to Traders Cheat Sheet. This is something that I developed for Barchart, and if you come down here, there it is. So what this is called the target price. Now, this is based on, it's a momentum value that basically tells us that all things being equal, if we get a movement, it projects forward, every day it projects forward where the target price should trade for that day. And so, the target price you can see today was 375.82. Now, again, the previous day's close was 374.85. So all things being equal, if we believe we're in an uptrend, then we should test or trade 375.82. And you can see our high got up to 377.23. So this is telling me that our trend is still intact. Now, if the market doesn't get to the target price, then that tells you have a change in momentum. So this is a really cool little piece of information you could look on a daily basis on your trader's cheat sheet that could give you a forward projection, a forward indicating number based on momentum. I know it's a little bit of a strange idea, but check it out. See if it does not work for you.
We got a follow-up, John, here, and somebody suggests that Fibonacci might be a leading indicator. Do you agree with that or not really?
I think it is more of a self-fulfilled prophecy indicator, right? Because I think a lot of traders look at it.
Yeah, when it works, it's mentioned as the holy grail, and when it doesn't,
right? Yeah, right. It's kind of like Elliott wave theory. I mean, you put 100 Elliott wave theorists in a room, and you get 100 different analysis, right?
John, this is a question from your buddy Jim Van Meerten.
Hey, Jim.
Does a bear market appear when the S&P 500 is off 5, 10, 15, or 20% from its 52-week high?
Come on, Jim. Well, I think the theory is 20%, right?
Yeah, that's the classical definition of a bear market is 20% off its 52-week high, and a technical correction occurs when it's 10% off.
Yeah, 10%. Now, I would say if you are off 10 or 15% and you've broken 2 or 3 near-term lows in, let's say, a weekly time frame, let's say you made a new 4-week low and you made a new 4-week month low, and then you made a new 6-month week low, and you're only off 10% or 12%, to me, that would be a sign that you're in a bear market because you've changed the structure of the market. You're making new lower lows. and new lower lows, lower highs, that would be, to me, it would be a bear market.
John, we got a question about your outlook for Microsoft. This is a great question. I'm curious about this myself because, man, the stock was on top of the world and it's just completely fallen apart here over the last
But
month.
it's the same story. It's Microsoft, it's Nvidia, it's Meta, right? It's the Mag 7s, right? It's all the same, right?
Not Google though.
Well, Google got hammered earlier in the year, and then it's finally let me just do something here. Go ahead, ask me another question. I set this one up.
I just quickly pulled up the Microsoft chart, and it's right above its 200-day moving average. So
that's what I was going to look for. Yeah,
it's at a critical juncture right now. I mean, as long as it stays above that, I mean, it's I guess it's okay. But
well, okay. So let me just let's see if I can do this in 30 seconds. So this kind of way I look at the markets, right? So the first thing I always do is I look at a higher time frame. I want to get a big picture. So if I look at this, and what I want to do is I want to look at my most recent high or pivot high and my most recent pivot low. And now what I use is sometimes what I'll do is I'll take the Fibonacci tool and I'll just draw that in there just to kind of give me a kind of a framework. And what do we see? Well, we're in the upper third of this range. So that's telling me that we're probably gone up, and that, if I want to be a buyer, I'm buying at risk. If I want to be a buyer, probably below, right, in the bottom third, right? But it does not mean that the market can't go higher. So what this is telling me is, hey, feeling like the market is probably going to go back to the mean, which would be somewhere in the middle. So that's my bias based on the weekly. Then I'll go to the daily, and then I'll do my analysis based on, what I see structurally, right? New lower lows, new lower highs. Am I breaking below technical support, right? Moving averages, weekly lows, weekly highs. And yeah, we're right on that that 200-day moving average, which also lines up with, I think if we do this on a weekly basis, a multi-week, right? 1, 2, 3, 4, right? We're right on that 4-week low. So 2 critical support levels. So this could be a low risk buy opportunity, but you're at risk if it breaks because, right, we could fall into the bottom half of this last range over the last, 5 months, 6 months?
The good thing I like, I talk about these big names all the time, John. The thing I like most about them is we know that they're not going to be a going concern as it could be with a smaller cap company. So even if you miss on your timing a little bit, you can sort of sleep easy at night knowing that these companies aren't going to go anywhere. And that makes a world of difference to me.
Right. I actually was doing Amazon. Here's Microsoft. So we are a little bit away from, let's take a look at our week. There we go. We are on that 200-day moving average. Okay.
We got a request, John, for you to do a soybean meal chart. Is that of interest to you, or?
It actually is because, again, disclosure, I'm in ADM, Archer's Daniel Midland, which is one of the largest soybean processors. And I was long on the idea that, the soybean market was going to rebound based on, the tariff idea with China. So I know that the bean oil market has been pretty strong as of late. Let's see. So again, one of the things you can do is when you come into your bean market here. So here's bean oil. We want to see which one has the most volume. You can see it's actually in the January contract. So that's when we want to do our analysis on. And this is going to be a clean sheet. So again, what's our weekly? Right? Here's our high. Here's our low. Right? Maybe we can even think about this being a pivot low. So we're in the lower end of that range or in the middle of that range. So that, to me, that's a buying opportunity. if my trend is up, which does look like it is, if I look at the daily, what's my trend? Well, my trend is kind of sideways, but I am at the lower end of the range. So again, I know if I buy, I know where my risk is. Now, again, the comparison, what I use is here's Archer's Daniel Minglen and main pain, left scale, actual value. You can see that there is a bit of a correlation. Does that show? I think that shows, right? Correlation between the price of bean oil and this particular equity.
I like this question, John. So this has kind of been a shaky week, maybe a shaky couple of weeks for the market. How do you think that plays into the fact that next week's going to be a bit on the quieter side due to the Thanksgiving holiday?
Well, if you think about our pump police and market makers, when the volume drops, it's a lot easier for them to maintain the market or even push the market higher. But I will say that, from my experience as a trader, is you kind of have a slow week, but for some reason, Thanksgiving week is not one of those slow weeks that you get a lot of traders who try to jam in a lot of trading before Thanksgiving, because first of all, they want to lock in profits before the end of the year. They don't want to have to deal with December, and also, you start getting, this is the time where you start getting that where they do the market washes, right? They wash trades, they take profits on losers, right? So there's, I don't know if that's typically what happens in the equity markets in terms of volume. Certainly the volume will be lower leading right up to Thanksgiving, but I bet you Monday and Tuesday will be very busy days.
All right, we got two more questions and then we'll wrap it up, John.
Okay.
Any thoughts on GE Vernova?
Yeah, it's one of my picks. It's been they're in everything AI in the development space. I really think this is a great company. Again, I think this is one of those companies, stocks that have been part of that AI trade where I think, maybe we've gone too far too fast. Maybe they've gotten a little bit ahead of themselves. And, maybe we need to have a little of a digestion in price. Now, I just pulled this up. This is our TTM squeeze template, and we are in the squeeze, which is telling us that we're at one of the lowest volatilities of this, and it's setting up to break out one way or the other. Now, we don't know which way it is, and I don't want to jump the gun here, but if we do see a correction in the greater market, this stock might break down to the downside. But this is definitely, for a long-term investment trade, I really like this one because they're in everything power related to the AI space. And they just, we just did an article on them. They just partnered up with Hitachi and to build some nuclear power plants as well. So these guys they got their fingers in everything power.
All right, last question. And I to be honest, I'm very reluctant to do it, John, because I just don't want to talk about it. But
I'm going to bring it up. I know what it is.
Can you guess?
Yeah.
What is there to say? We highlighted levels to watch. We highlighted the 50-week. You highlighted the 94 to 96 range. It's collapsed all the way through it. I mean, there's nothing really to say except it's over, guys.
Yeah, I said you might get a little bit of a speed bump here, and it did penetrate below there, and it does feel like it's holding there right now, 85. But I think your target on this one is the 76. Now, I did read something, Thomas, on this, is that Bitcoin miners are telling us that the cost to create a new Bitcoin is around $70,000. So if this is a true commodity, a digital commodity, then you should find a structural bottom based on the cost of what it is to mine a Bitcoin. But I don't know if that is 100% true.
Yeah. I just want to say, although it looks bleak, you could potentially, John, because we've seen this in past cycles, you could potentially have a counter trend rally here pretty soon because it's gotten hurt so bad. So you could see a counter trend rally back up to potentially somewhere around the 200-day, but I would not But if you're holding a position right now and you're asking yourself, should you get out now or should you wait a little bit? I'm not going to tell you what to do, but I feel like you're kind of, by selling now, I think it's very risky because you're really risking missing out on that potential counter trend rally.
Right. And remember, our 3 candle drops. Now, this is not a great example of, but this red candle was all the way down here. So this would have qualified as a 3 candle drop. So what we need now is a green candle Monday, or actually probably over the weekend, Sunday. And what I would like to see is us get back inside the Bollinger Band and then take out this high. That would be a positive sign for you. So there is some potential here because it's extremely oversold and it got way outside. When you get a big piercing like this outside the Bollinger Band, that usually is a temporary bottom for sure.
Yeah, and it's off about 32%, John, from its all-time highs, and it's done so in relatively short order. This is where I think people sort of maybe sometimes often make panic and emotional decisions. They get scared, but for me, I think we've gone through the most painful period here, and it's.
I agree with you. Yeah, and it's probably more about market liquidation, right? From leverage, right, in the market.
Yeah, and potentially, I've heard there's been some OG people who have been in the space for a long time. They've been selling their wallets, John. Maybe you've got some treasury companies, right? We saw all these treasury companies spring up. Maybe some of them are in trouble and they have to unload. So who knows?
There you go. Here, I've went to a weekly time frame. I just went through the different times. There you go. There's your 3 candle drop. Now we need a weekly green candle that would set up for a nice mean reversion. And what was the number you said? The 200-day?
200-day, yeah.
Which was around where?
I think it's 100-ish.
Okay.
Yeah, I think it's 100-ish.
All right.
All right. That is going to do it for today's show, John. I just want a couple announcements. Next week, guys, of course, the Thanksgiving holiday. So John and I will be off. I hope you guys enjoy your week off. Have a great holiday with your family. Hopefully we'll have some exciting things to talk about when we come back the next week, John. So last show, I also threw out the idea of a Q&A only market on close. So we got some positive feedback on that, John. So I think we're looking to do that potentially on Tuesday, December 30th, guys. So circle that on your calendar as a rough date for a Q&A only show. And as we get closer to that date, go ahead and email those questions to marketonclose@barchart.com. And hopefully we'll get a lot of them and we can have a nice Q&A only show.
I think that'll be exciting. So, and what's going to make it for an exciting show, folks, is we need the questions. So send those in for us so we can prepare a good answer for you. So what's the date again, Thomas?
That one roughly scheduled currently for Tuesday, December 30th.
Okay, great. Awesome. And no, we might have a scheduled change in the middle of December as well, too, right? Do we want to hold that off on that one?
Yeah, we'll talk about that when we come back the first week of December.
Gotcha. Okay, great. Folks, Thomas, great show today. Folks, I hope you guys enjoyed. I hope you get something out of it. I hope you can find some alpha out of today's show. Enjoy Thanksgiving. Count your blessings. Love your family. Until next time, the best of health, manage your risk, and the good of all trading.